Welcome to the Deep Dive. Today, we're going to be looking at tax-aware long-short factor investing.
Wow, that's a mouthful.
It is a mouthful, and you've given us quite a stack of academic papers to look at today.
Yeah.
We're excited to break down these strategies and figure out how they could potentially help people outperform the market while keeping more of their money.
It's really interesting stuff. It's definitely an area that's getting a lot of attention these days,
Sure.
especially as technology makes these kinds of sophisticated strategies more accessible to everyday investors.
Yeah, I mean, that's what's really fascinating to me is that these strategies that were once, only available to, super high net worth individuals or institutions are now becoming something that, your average person can at least consider.
Absolutely.
So we're talking about going beyond just typical direct indexing here,
Right.
which is great for tax management,
Yeah.
but it's limited to just kind of mimicking those passive index holdings.
Yeah, for the most part, you're right.
So we're aiming for something more ambitious here. We want actual market-beating returns while being smart about taxes.
That's the goal.
Okay, so long-short factor investing.
All right, break that down.
It sounds a little intimidating.
It does sound a little jargony.
Could you demystify that for us?
Sure. So imagine you have like two sides to your portfolio.
Okay.
One side is the long side.
Yeah.
You're betting on assets that you think are going to go up in value.
Right.
The short side is kind of the opposite.
Yeah.
It's betting on certain assets to decrease in value.
Gotcha.
And then factor investing adds another layer to it,
All right.
where you're identifying specific characteristics or factors
Right.
like value or momentum that have historically been shown to drive market returns.
So it's more targeted than just, buying the S&P 500 and hoping for the best.
Right. It's not just riding the market wave.
Yeah.
You're trying to be a little more strategic with your stock picking.
And that's where the tax-aware piece comes in.
Yeah, that's where the real magic starts to happen.
Well, that's what I want to get to, because it seems like these strategies are designed to not just pursue market-beating returns, we'll call that alpha for our listeners,
Right.
but also to minimize your tax liabilities through these really carefully constructed trades.
Absolutely. That's a key part of what makes these strategies so appealing.
You're not having to choose between tax efficiency and returns.
Right. You can aim for both.
Okay. I'm intrigued, but I'm also always a little wary of things that sound too good to be true.
Of course.
Where's the catch?
Right.
Does aiming for tax efficiency mean that you're having to sacrifice potential returns?
That's a common concern, but what's interesting is that the research really suggests otherwise.
Okay.
You don't necessarily have to make that trade-off. These strategies try to thread that needle.
So how do they pull that off?
Well, it really comes down to aligning your trading patterns with your alpha model,
Okay.
which is essentially the engine that's driving your market-beating returns.
Yeah.
These strategies prioritize a few key things. Number one is strategically liquidating losing positions to capture those tax benefits.
Okay.
Number two is nimbly creating new positions as alpha opportunities emerge.
So they're not just sitting on their hands.
No, they're actively managing the portfolio.
They're looking for those opportunities.
Right.
Okay.
And the third thing is avoiding the unnecessary liquidation of winning positions.
Okay.
Let those gains compound and grow.
Yeah, you want to ride those winners for as long as you can.
Exactly.
So it's not just reacting. It's being opportunistic.
It's about being smart and strategic with your trading decisions.
Now, I think we have to address what the research paper calls relaxed constraint and composite long-short strategies.
RC and CLS, the alphabet soup of investing.
Yeah, they both sound a little like alphabet soup to me.
Right.
But can you break those down?
Yeah, so think of them as two different routes to get to the same destination.
Okay.
They both are trying to achieve similar pre-tax alpha and generate comparable levels of tax savings.
Okay, so same goal, different paths.
Right.
Walk me through it. What makes them unique?
So RC strategies hold individual stocks for both your market exposure, which we call beta,
Right.
and the alpha-generating long-short positions.
So it's like a one-stop shop.
Kind of, yeah.
Yeah.
You're getting your market participation and your active management all in one.
Okay. Straightforward enough. What about CLS?
CLS strategies take a little bit more of a compartmentalized approach.
Okay.
So they'll use like a low-cost index fund or an ETF for the beta component.
Okay.
So your core market exposure is in something that's typically pretty tax efficient.
Right.
And then you use individual stocks solely for those long-short extensions to pursue alpha.
So RC is all-in-one CLS, separates those two pieces.
Exactly.
Does the research suggest one is better than the other?
Not really. The AQR paper finds that they both deliver pretty comparable results, both in terms of pre-tax alpha and this thing called cumulative net capital loss, or CNCL.
Ooh, CNCL.
Yeah.
Now that's a new one for me.
We got to dive into that.
What is CNCL and why should our listeners care?
Think of CNCL as like your tax-saving secret weapon.
Ooh, I like it.
It's the total amount of capital losses that you can use to offset capital gains.
Okay.
So it directly reduces your tax burden.
So the more CNCL you have,
The less taxes you're paying.
the better.
Exactly. And what's remarkable about these long-short strategies is that they can generate a lot of CNCL,
Okay.
sometimes exceeding 100% of your initial investment within the first few years.
Wow. So more than 100% of your initial investment.
It's pretty impressive.
That's huge. But I feel like we need to address, is this just loss harvesting at work here?
That's what a lot of people think.
That's the term that gets thrown around a lot.
Yeah, and this is where it gets really interesting. A 2024 paper that looked into this found that it's not just about maximizing losses. It's actually more about minimizing realized gains,
Okay.
especially those pesky short-term capital gains.
So you're not just selling the losers, you're also strategically holding on to the winners.
Exactly. You're playing a bit of a long game with the tax man.
It seems very counterintuitive to how most people think about tax-efficient investing.
It is, but it can make a big difference.
So how does that work?
Well, let's say you have a stock in your portfolio that's doing really well.
Okay.
The traditional approach might be to sell it, lock in those gains,
Celebrate.
right? But that triggers an immediate tax liability.
The party's over.
Exactly. Uncle Sam wants his cut.
Especially if you haven't held it that long.
Right. Short-term capital gains can be a real drag.
Okay.
Now, a tax-aware long-short strategy might say, hold on, let's hold on to that winning position a little longer.
Yeah.
Defer those gains, let them compound even further
Okay.
before we have to pay taxes.
So it's like letting that money snowball before having to share some of the snow with Uncle Sam.
Right. It's about maximizing the power of compounding by strategically managing the timing of those gains.
Okay, I'm starting to see the light here.
Good.
But I have to ask, are we sacrificing potential returns by being so patient with our winners?
That's where the strength of your alpha model comes in.
Okay.
A really good model should tell you not just when to buy and sell for market-beating returns,
Right.
but also when to hold for optimal tax efficiency.
So it's not just about picking stocks.
Right. It's about managing them with both returns and taxes in mind.
Okay, so it's like this financial GPS that not only navigates the market,
Right.
but it can also help you outsmart the tax man.
That's a great way to put it.
Okay, I want to dig into this dynamic de-risking thing, but I think that probably deserves its own segment.
Yeah, let's save that for next time.
I think we've given people enough to chew on for now.
Absolutely.
But before we go, any final thoughts as we head into part 2?
I would just say the biggest takeaway so far is don't settle for this trade-off between returns and tax efficiency.
Yeah.
You know, these strategies show that it's possible to pursue both
Yeah.
and potentially achieve really impressive results.
Yeah.
But you have to understand the nuances and seek some expert guidance along the way.
Right, we'll leave it there for now. We'll be back with part 2 soon.
Sounds good. You know, it's funny how these tax-aware long-short strategies really flip the script on how we typically think about taxes in investing.
Yeah, it's like we're trained to think of taxes as this, like, unavoidable evil.
Right, like this drain on your return.
Something we just kind of accept.
Grudgingly.
Yeah. But these strategies seem to use the tax code to their advantage.
Yeah, it's a subtle but powerful shift in perspective.
Almost like they're turning a headwind into a tailwind.
Exactly. And a big part of that comes back to those impressive cumulative net capital losses, those CNCLs we were talking about.
Right, that potential to rack up CNCL exceeding 100% of the initial investment.
That's a game changer.
That's huge.
Yeah.
But how do they generate so much CNCL? Is it just aggressively looking for losses?
That's tempting to think, but you got to remember that 2024 paper,
Yeah.
the one that really dug into the source of these tax benefits,
Mm-hmm.
it found that the real magic isn't just about maximizing losses, it's also minimizing realized gains,
Okay.
especially those short-term gains that tend to get hit hardest by taxes.
So it's not just selling the losers, it's also holding on to the winners strategically.
Exactly. It goes against what a lot of people think about tax-efficient investing.
Yeah, it's very counterintuitive.
It is, but it can be incredibly powerful.
So walk me through an example. How does this play out in practice?
Sure. Let's say you've got a stock in your long-short portfolio that's doing really well.
Okay.
Now, a traditional approach might be to sell it and lock in those gains.
Celebrate.
Right. But then you get hit with that immediate tax liability.
The party's over.
Right.
Yeah.
Uncle Sam's at the door, ready for his cut.
And if you haven't held it that long?
Especially then, Short-term capital gains can really eat into your profits.
Okay.
Now, a tax-aware long-short strategy might say, hold on a second. Let's hold on to that winning position a little longer.
Yeah.
Let those gains ride, defer those gains, let them compound even further.
Okay.
Before we have to worry about paying taxes on them.
So you're maximizing that snowball effect before you have to share it.
Precisely. It's all about using time to your advantage, leveraging the power of compounding while strategically managing those tax implications.
I love that analogy. Okay, so this gain deferral concept, I see how it can be so powerful.
It's a subtle shift, but it can make a big difference in the long run.
But I have to ask, is there a downside to all this patience?
Of course, there's always a balance.
Are we potentially missing out on other opportunities by holding on to winners for too long?
That's a valid concern, and it highlights why having a strong alpha model is absolutely critical.
Yeah.
Remember, the alpha model is the brains of the operation.
The brains of the operation.
It's not just about identifying when to buy and sell for those market-beating returns.
Okay.
It's also about knowing when to hold for optimal tax efficiency.
So it's like having a financial advisor and a tax strategist all rolled into one.
Exactly. It's about finding that sweet spot between maximizing returns and minimizing your tax bill.
I see. And does this concept of gain deferral apply differently to those two different approaches we talked about?
You mean RC and CLS?
Yeah, RC and CLS.
Yeah.
Do they handle it differently?
They do, to some extent. Remember, RC is using individual stocks for both beta and alpha.
Right.
Whereas CLS separates them using an index fund for beta and individual stocks for alpha.
Yeah.
That separation in CLS can actually enhance your ability to defer gains on that beta component.
Okay.
Because index funds tend to have lower turnover rates.
So you're getting a double dose of gain deferral.
Potentially.
Okay.
On both the beta side and the alpha side.
Interesting. Okay, so gain deferral check. Alpha model check. Now I think it's time to tackle this separation of alpha and beta.
Ah, yes. Another key concept.
It sounds very sciencey to me.
It does sound a bit like physics.
But I know it's important for understanding how these tax-aware strategies work.
It is. Absolutely. So let's break it down.
Yeah, please do.
Imagine you have two distinct goals when you're investing.
Okay.
One goal is to just participate in the overall market.
Ride the wave.
Right. Ride the general market growth.
Yeah.
That's your beta,
Yeah.
the foundation of your portfolio.
Okay.
And then your other goal is to generate returns that actually outperform the market.
You want to beat the waves.
Exactly. You want to beat the average. That's your alpha. That's the part of your portfolio that's actively seeking out opportunities for those excess returns.
So two buckets, one for riding the wave, one for beating the wave.
Precisely. But how does separating those two buckets lead to tax efficiency?
Yeah, that's what I don't get.
Well, it allows you to tailor your tax strategy to each bucket.
Okay.
So your passive beta bucket, which is typically invested in a broad market index fund, that's likely to generate steady returns, but those returns are often taxable gains.
So no escaping taxes even on the passive side?
Not necessarily, but by separating it from the alpha portion, you can potentially minimize the tax bite.
Okay.
The key here is to aim for long-term holding on those passive beta investments.
Let those gains simmer.
Exactly. Let them grow undisturbed for as long as possible.
Okay.
Meanwhile, your alpha bucket, your long-short portfolio, that's where you're actively generating those market-beating returns.
Where all the action is.
Exactly. And that often involves more frequent trading.
But doesn't that trading activity trigger taxable events?
It can, but that's where the tax awareness comes in. These strategies are designed to minimize realized gains and maximize losses within that alpha bucket.
Okay.
Effectively offsetting the potential tax hit from that passive beta portion.
It's like a dance between those two buckets.
That's a great way to put it.
The beta bucket is simmering away, deferring those gains.
Right.
And the alpha bucket is generating those excess returns and managing those taxable events.
It's a beautiful synergy when you think about it.
So it's not just about picking stocks or timing the market.
No, it's bigger than that.
It's about managing them in this framework that optimizes both returns and taxes.
Exactly. It's a holistic approach to investing. You're looking at all the angles.
All right, so we've established these tax-aware long-short strategies sound really good in theory.
They do sound promising.
But do they actually work in the real world?
That's the million-dollar question.
What does the research tell us?
Well, thankfully, the research offers some encouraging answers.
Okay.
The papers that we've been looking at, they've used both simulated and historical data to put these strategies to the test.
Okay.
And they've done it across a range of different market conditions.
So they're not just cherry-picking data.
No, they're trying to be as rigorous and realistic as possible.
Okay, good. But I'm sensing a but coming.
There's always a but. Right.
There always is.
And this is an important one. While the research is really promising, it's important to remember that the actual performance of these strategies really depends on a number of factors.
Okay, so they're not foolproof.
Right. They're not a guaranteed win, and they're certainly not right for every investor.
So what are the potential downsides or challenges that investors need to be aware of?
Well, the biggest factor, as we've touched on already, is the skill of the alpha model.
Yeah.
It's the engine that drives those market-beating returns.
Right. If the engine's no good, the car's not going anywhere.
Exactly. If the model isn't effective at consistently identifying and exploiting those market inefficiencies, then the whole strategy falls apart.
So how can investors assess the quality of an alpha model?
Well, this is where working with a qualified financial advisor is really important.
Okay.
They have the expertise and the resources to evaluate different alpha models, understand their underlying assumptions, look at their track records.
It's like having a mechanic inspect the engine before you buy the car.
That's a great analogy. You need someone who knows what they're looking for.
Yeah.
You can spot those red flags.
Okay, so solid alpha model, non-negotiable. What else?
The effectiveness of the tax optimization techniques is just as important.
Yeah.
These strategies aren't just about picking stocks.
Right.
They're about managing them strategically from a tax perspective.
It's like having a really powerful engine.
Yeah.
But you need a skilled driver to handle it.
Absolutely.
Yeah.
And that's why partnering with a financial advisor who specializes in tax-aware investing can be so valuable.
I can be your co-pilot.
Exactly. They can help you navigate all the complexities of the tax code and make sure you're taking advantage of every opportunity.
Okay, so alpha model check, tax optimization check. What's the final piece of the puzzle here?
The third crucial element is understanding your own individual tax situation and your investment goals. There's no one-size-fits-all approach here.
So it's about understanding how this fits into your overall financial picture.
Exactly. What works for one investor might be completely wrong for another.
So you really need to look at your own unique circumstances.
Your risk tolerance, your time horizon, all of these factors come into play.
And this is where a financial advisor can really help.
They can be your financial architect.
Help you connect all those dots.
Exactly. Making sure that these strategies actually align with your specific needs and your long-term objectives.
Okay. It's all coming together now.
Yeah.
But I have to admit, I'm still a little mystified by how these strategies can generate such significant tax savings.
Yeah.
I get the concept of gain deferral and loss harvesting, but the magnitude of those tax benefits is just mind-boggling to me. What's the secret sauce?
It's not so much a secret sauce as it is a symphony of different factors all working together.
Okay.
One key element is the high level of diversification in these long-short factor strategies.
Diversification, that's investing 101.
Right. It's a fundamental principle of sound investing.
But I'm missing the connection between diversification and tax savings.
Okay, well, think about it this way. With a diversified portfolio, you're more likely to have a mix of winners and losers at any given time.
Right. Some are going up, some are going down.
Exactly. And that gives you more opportunities to strategically harvest those losses to offset any gains you might have.
Ah, I see. It's like a buffet of tax loss harvesting opportunities.
That's a great way to put it. And the more diversified your portfolio, the more options you have on that buffet.
Okay, diversification check. What else is contributing to these tax benefits?
The presence of those short positions is another key ingredient.
Okay.
Remember, in a long-short strategy, you're not just betting on assets to go up. You're also betting on some to go down.
Right. You're playing both sides.
Exactly. You're playing offense and defense. And in a rising market environment, which is what we've generally seen over the past decade, those short positions are more likely to generate losses.
So those losses on the short side can help offset the gains on the long side.
Precisely. It gives you another avenue for tax loss harvesting.
It's like a built-in hedge against taxes.
I like that. A way to cushion the blow when the market is charging ahead.
Okay, so diversification, short positions, anything else?
Well, leverage plays a role as well.
Leverage.
Remember, leverage is using borrowed money to amplify your returns.
Right, we talked about that. It can be powerful, but also risky.
Absolutely. But when used prudently, leverage can significantly enhance returns.
Okay.
And in the context of these tax-aware strategies, leverage can actually magnify the tax benefits as well.
Wait, how does leverage reduce taxes?
Think about it this way. When you use leverage, you're essentially increasing the size of your positions. And larger positions mean the potential for bigger gains and bigger losses.
It's a double-edged sword.
Right. But remember, we're talking about tax-aware strategies. So those larger losses, if they occur, provide even greater opportunities to offset any gains you might have.
Ah, so it can actually work in your favor from a tax perspective.
Exactly. Leverage can amplify those tax benefits.
Okay, that's fascinating. So we've got diversification, short positions, leverage. Anything else we need to add to the mix?
One more, and it's a crucial one. The relatively slow turnover of these factor strategies.
Okay.
Remember, these strategies aren't about chasing trends or jumping in and out of the market.
They're playing the long game.
Exactly. They're about identifying those fundamental factors that drive returns over the long term.
And that slower turnover rate actually helps with tax efficiency.
It does. Fewer trades mean fewer taxable events.
It's like slowing down to make sure you're making the right moves.
That's a great way to put it. These strategies are about being deliberate and strategic.
Not impulsive. Okay, I think I'm finally starting to understand how all these pieces fit together.
Good.
We've got diversifications, short positions leverage, and a slower turnover rate,
It's a beautiful combination.
all working together to minimize those realized gains and maximize those valuable losses.
And when you combine those factors with a skilled alpha model and expert tax management,
Yeah.
you have the potential for a really powerful and efficient investment approach.
It sounds almost too good to be true.
I know, right?
But are these strategies truly accessible to everyone?
That's a great question, and it's one that's constantly evolving as the financial landscape changes.
Yeah.
Traditionally, these types of strategies have been more readily available to institutions.
Right, the big players.
Yeah, those with huge portfolios and sophisticated in-house teams.
Yeah.
But thankfully, technology is changing that.
It's becoming more democratic.
Exactly. We're seeing a growing trend towards greater accessibility,
I like that.
with more platforms and products specifically designed for individual investors.
That's great news. But I'm guessing there's still some hurdles. What should investors be aware of as they explore these strategies?
Well, first and foremost, due diligence is absolutely essential.
Okay.
Just because a strategy says it's tax aware doesn't mean it's automatically a good fit for you.
Right.
You really need to do your homework.
Understand what you're getting into.
Exactly. Understand the methodology, the risks, the fees.
So don't just jump in blindly.
Yeah.
No. Do your research, ask tough questions, make sure you're comfortable with what you're investing in.
And this is another area where a financial advisor can be really helpful.
Absolutely. They can be your guide through this complex world of investing.
Okay, so due diligence check. What else?
Even as these strategies become more accessible, it's important to approach them with caution.
Okay.
Seek expert guidance. Make sure they align with your individual circumstances and goals.
So it's not a set it and forget it kind of thing.
Definitely not. It's an ongoing process.
All right. Well, I think we've covered a lot of ground today.
We have. It's been a really in-depth look at these strategies. From the basics of long-short factor investing to the nuances of gain deferral and the importance of that alpha model.
And don't forget diversification.
Oh yeah, diversification. That's key.
Absolutely. It's all connected.
But as we've emphasized throughout this episode, it's not a do-it-yourself project.
You're right. These strategies require expertise and ongoing guidance.
If you're intrigued by what you've heard today and you want to explore whether these strategies might be a good fit for you,
Yeah.
the first step is to reach out to a qualified financial advisor who specializes in this area.
Absolutely. They can help you assess your situation, tailor a strategy to your specific needs, and guide you through the whole process.
It's like finding a good architect to design and build your dream home.
Exactly. You wouldn't try to do that yourself, would you?
Not if I wanted a solid foundation.
And a roof that doesn't leak.
Okay, so as we move into the final part of our deep dive, I want to encourage our listeners to keep exploring this world of tax-aware investing.
It's a fascinating area with a lot of potential.
Don't be afraid to challenge those old assumptions and look for new ways to enhance your financial well-being.
And remember, this is just the beginning of the journey. There's always more to learn.
Well said. Now let's take a quick break, and when we come back, we'll dive into dynamic de-risking, which adds a whole new level of flexibility to these strategies. Welcome back to the Deep Dive. We've been spending some time with these tax-aware long-short factor investing strategies.
Yeah.
And now I want to get into this idea of dynamic de-risking.
Right. Dynamic de-risking, it really adds a whole other layer of sophistication, doesn't it?
It does, and we touched on it a little bit earlier,
Uh-huh.
but I think it deserves its own conversation.
Yeah, I think so too.
So can you remind us what this concept is all about?
Sure. So imagine you're going on a road trip, right?
Okay.
You have your destination in mind.
Yeah.
But you might hit some detours along the way,
Right.
road closures, Or maybe you just decide you want to take a more scenic route.
Okay.
Dynamic de-risking is kind of like having that flexibility built into your investment journey.
Yeah. It lets you adjust your course based on changing conditions.
So you're not locked into one rigid plan.
Exactly. It's about being able to adapt as you go.
Now, those changes could be in the market, they could be in your own life, or even in how much confidence you have in the alpha model.
Right. Those are all valid reasons to potentially adjust your strategy.
Okay, so how does this play out in practice? What are the things we can actually change?
Well, remember those two key dials we talked about.
Yeah.
Leverage and tracking error.
Uh-huh.
Dynamic de-risking allows us to kind of fine-tune those dials
as needed. So remind us again, leverage is using borrowed money to potentially juice those returns.
Right.
And tracking error is how much our portfolio is deviating from the benchmark.
Exactly.
In pursuit of that alpha.
Exactly. So dynamic de-risking lets you adjust those dials based on your risk tolerance, your time horizon, how the market is behaving, all sorts of factors.
Yeah, so it's about having more control over how much risk you're taking and how closely you're sticking to the benchmark. Right. It's about finding that balance that works for you at any given time.
But how do we do this in a way that's tax efficient? How do we avoid triggering a bunch of taxes when we make these adjustments?
That's the real art of it, isn't it?
It is. It seems tricky.
It's not about making big, sudden changes that can really shock the portfolio and generate a bunch of taxable events. It's about making gradual, strategic adjustments.
So you don't want to slam on the brakes.
No, you want to ease into it.
You want to make these changes very deliberately and carefully.
Exactly. And that's why having a qualified financial advisor in your corner can be so valuable.
Yeah, they can help with the timing of those moves.
Absolutely. They can be your choreographer, helping you navigate these moves smoothly and gracefully.
Okay, so I'm starting to get a better picture here. But the research mentions two main approaches to dynamic de-risking.
Right.
Scheduled and optimized. Can you break this down for us?
Sure. So think of scheduled de-risking as kind of setting a predetermined course, like programming your GPS with a specific route and estimated arrival time.
Yeah.
You decide in advance how you're going to gradually reduce leverage and tracking error.
Over a specific period.
Right. It's a more hands-off approach. You set it and forget it, sort of.
So it's good for people who like that kind of structure and predictability.
Yeah. If you want to know what to expect and when to expect it, then scheduled de-risking might be a good fit.
Okay, what about optimized de-risking?
Optimized de-risking is a little more sophisticated.
Right.
It's like having a smart GPS that's constantly recalculating the route based on real-time traffic conditions.
So it's more adaptable.
It is. It continuously adjusts leverage and tracking error based on all sorts of things.
Okay, so what kind of things does it take into account?
Market volatility, your tax situation, even how the alpha model is performing. It's constantly taking in new information and adjusting the strategy accordingly.
So it's more responsive to those changing conditions.
Yeah, but it's also more complex to manage. You need a deeper understanding of all those moving parts.
So it's like choosing between a manual and an automatic transmission.
That's a perfect analogy.
They can both get you to your destination, but one requires a little more skill and attention.
Right. And ultimately, the right approach for you really depends on your individual needs and preferences, your comfort level with complexity.
Okay, with two different ways to do this dynamic de-risking thing. But regardless of which approach we choose, what are some of the potential pitfalls? What do we need to be careful about?
The biggest challenge is avoiding those unwanted capital gains realizations.
Right.
Remember, the whole point of dynamic de-risking is to adjust our strategy smoothly without sacrificing that tax efficiency.
It's like trying to change lanes in rush hour traffic.
Exactly. You don't want to cause an accident.
That time it right.
You got to be smooth. You got to be strategic.
Yeah, and that's where having that experienced financial advisor can really make a difference.
They can help you navigate those tricky situations and make sure you're staying on course.
They can be your co-pilot.
Exactly.
Well, I think we covered a lot of ground today.
We have.
From those long, short factor investing basics to this idea of dynamic de-risking.
It's been a whirlwind tour.
It has. And, you know, I think our listeners are probably feeling a lot more informed.
I hope so.
But maybe also a little overwhelmed.
It's a lot to take in.
But I think the main takeaway here is that tax-aware investing, it's not about settling for mediocre returns just to save a few bucks on taxes.
Right. It's not about being cheap.
It's about being smart and strategic.
Exactly. It's about using the tax code to your advantage.
Yeah, maximizing those returns while minimizing what you owe.
And I think we've shown that these strategies can be a powerful tool for doing just that.
Yeah, they really can. but they're not a DIY project.
Definitely not.
You need that expertise and that guidance to really make this work.
Absolutely.
So if you're intrigued by what you've heard today and you want to learn more,
Yeah.
the first step is to reach out to a qualified financial advisor who specializes in tax-aware investing.
They can help you figure out if it's right for you.
Yeah, they can tailor a strategy to your needs and guide you through that whole process.
It's like finding a good architect to design and build your dream home.
Yeah, you wouldn't want to try to build your own house without an expert.
Right. It's a recipe for disaster.
So as we wrap up this deep dive, I want to leave our listeners with this thought.
Okay.
Don't be afraid to challenge the conventional wisdom when it comes to managing your money.
Yeah, think outside the box.
Embrace those new ideas.
The world of investing is always changing.
It is. So keep learning, keep exploring, and find those opportunities to build a brighter financial future.
Couldn't have said it better myself.
Until next time, keep those brains engaged and happy investing.